Welcome, welcome. I'm Amy, and I'm really glad you're joining us today.
And I'm Tom. Uh, our goal here really is to cut through all the noise from the latest financial and geopolitical headlines.
Exactly.
We're here to sort of distill the most important insights from what moved markets on June 24th, 2025.
Hmm.
You know, understanding the what and the why behind recent shifts.
Yeah, everything from stock performance to commodity prices and global economic indicators.
Think of it as your shortcut, maybe, to being well-informed without feeling, completely overwhelmed.
Right. We've sifted through the reports, the research, the data, and, well, we're ready to guide you through the most surprising developments and complex movements you probably need to know about.
Okay, so let's jump right in then with a global market snapshot. Looking at June 24th, what immediately stands out? What was the market reaction?
Well, U.S. markets certainly saw a rebound. The S&P 500, it was up almost a full percentage point, 0.96%.
Right.
And the Nasdaq 100 gained even more, rising 1.06%.
Hmm.
But what's interesting is that at the same time, U.S. Treasury yields were down. The 10-year dropped 3.4 basis points to 4.349%.
And that's not all, is it? We saw that really significant plunge in Brent crude,
Huge.
down over 9%,
Yeah.
landing at $70.14 ever. And the dollar index, it also retreated, 0.43%.
Yeah.
So this initial snapshot, it really paints a clear picture, doesn't it? Market sentiment on the 24th shifted, dramatically towards de-escalation, especially in commodities.
Right, which then gave equities room to rally.
Exactly. It suggests that a significant amount of risk premium, particularly around those geopolitical tensions, was just, well, quickly unwound.
And as we look ahead, there's a pretty packed economic calendar that could definitely move markets further this week.
Oh, definitely.
We're watching the German IFO surveys closely. Plus, we've got a whole slew of central bank officials speaking,
Right.
including the ECB's Louis Seguindos and Philip Lane, and from the Bank of England, Megan Green, Dave Ramsden, Andrew Bailey, and Sarah Breeden. Quite the list.
It is. And on the U.S. side, you'll want to listen for key Fed officials like Beth Hammack, John Williams, Neel Kashkari, and Michael Barr.
Mm-hmm.
But the biggest highlight for you, I think, will be Fed Chairman Jerome Powell's testimony.
Ah, yes. Before the U.S. House Financial Services Committee. That always commands attention.
Always does.
Yeah.
And we also have the Bank of Japan's summary of opinions on the docket. So it's certainly a week to keep an ear to the ground.
Definitely. Okay, let's delve a bit deeper into U.S. stocks and some, well, pretty intriguing corporate headlines from the day.
Okay.
Despite some early volatility, stemming from those initial reports of an Iranian missile launch, U.S. stocks actually overcame those jitters. They closed higher.
Right.
The Dow Jones Industrial Average gained 0.89%, the Nasdaq 100 was up 1.06%, and the S&P 500 rose 0.96%.
The really significant takeaway here, I think, is the breadth of those gains.
Yeah.
10 of the S&P 500's 11 sectors ended the day in positive territory. So this isn't just a few big tech names driving the market, right?
Yeah.
It signifies a widespread improvement in investor confidence. It suggests a more generalized positive sentiment across a diverse range of industries once those initial geopolitical concerns started to recede.
And speaking of industries, some corporate news really caught our eye.
Mm-hmm.
Novo Nordisk, the maker of Wegovy, that blockbuster drug,
Oh, yeah.
they abruptly terminated their partnership with Hims and Hers Health. They accused them of deceptive marketing for selling copycat versions. That's quite a bold move protecting their IP.
It certainly is. And we also saw Ford Motor stepping up its efforts really to protect those clean energy manufacturing subsidies.
Right, warning about jobs.
Exactly, warning that jobs at its Michigan EV battery plant are at risk if the tax credits get cut.
Hmm.
And on the competition front, Compass, the real estate brokerage, filed a lawsuit against Zillow Group.
Alleging anti-competitive tactics over Zillow's new listing restrictions. That could be interesting.
Yeah. And there is Omnicom Group, the advertising giant.
Oh, yeah. What happened there?
They agreed to stop withholding online ads for political reasons. Apparently, this was to secure federal antitrust approval for its massive, $13.5 billion acquisition of Interpublic Group.
Wow. Okay, so these headlines might seem a bit disparate, but when you start to connect the dots...
They absolutely tell a story. What these, seemingly unrelated corporate headlines really highlight for you is the increasing influence of external pressures on business strategy. It really is fascinating.
Oh, so...
Well, whether it's regulatory scrutiny from the FTC demanding changes in Omnicom's practices, right?
Mm-hmm.
Or the direct, tangible impact of government subsidies on Ford's production plans and, well, job security,
Yeah.
or even just fierce competition forcing legal battles like Compass versus Zillow companies today aren't just navigating market demand. It feels like they're intensely lobbying and battling policy shifts and, stringent antitrust oversight.
So that's becoming as critical as market innovation
It
itself.
seems like it, yeah,
Yeah.
almost.
Okay, bringing it back to the S&P 500 sector performance. Consumer discretionary was the standout, wasn't it? Up 1.75%.
Was.
That included strong performances from Tesla, which soared over 8%,
Wow.
DoorDash and Lennar too.
But in stark contrast, energy was the worst performing sector, down, what,
That's right. Yeah.
2.51%?
Companies like APA, Halliburton, Schlumberger all seeing significant declines.
This divergence, it's incredibly telling, isn't it, about investor confidence and global dynamics.
How so?
Well, that rapid drop in oil prices, which we'll dig into more in a sec,
Right.
it directly benefits discretionary spending, right?
Hmm.
Reduces costs for consumers, but at the same time, it hammers energy companies.
Oh, okay.
It's a classic example of how a single market event can just ripple across the entire economy,
Mhm.
creating very clear winners and losers.
Indeed. We also saw some strong performance in the mega caps. Meta Platforms, Microsoft posting solid gains, and Tesla, as we said, continuing its impressive run. The information technology sector had its own sort of mixed bag, though. Arista Networks did well, but Supermicro computers struggled.
Yeah, and similarly, in materials and mining, you had PPG Industries up, but then CF Industries Holdings was down.
Right.
It just reinforces that even within these broader market trends, specific company performance and, subsector dynamics can lead to very different outcomes,
Mm.
often driven by individual company news or unique market pressures that aren't immediately obvious in the wider indexes.
Okay, let's shift our focus now to the Middle East and how those geopolitical tensions played out in the markets. Gold prices, interestingly, ended the day relatively unchanged, up just 0.02% to $3,368.41 an ounce.
Right, but that calm closing price really hides what was actually a very volatile day for gold.
It certainly does.
What's truly fascinating here is how quickly the market processed and reacted to the unfolding events. Gold initially surged, didn't it?
It did, yeah. Fueled by escalating tensions, specifically those intense reports of Israel's bombing of Tehran's Evin prison.
But those gains were almost immediately pared back.
And this is where the story gets really interesting, I think. Iran responded by launching 6 missiles towards U.S. bases in Qatar, but critically, subsequent reports confirmed no casualties.
Right, that was the key.
That single development just profoundly tempered market fears.
Hmm.
It seemed to indicate a desire for de-escalation rather than, full-blown conflict.
And then came the definitive turn, that U.S. brokered ceasefire between Israel and Iran. Quickly announced, quickly agreed upon.
Yeah, President Trump himself confirmed it on Truth Social, stating there was a complete and total ceasefire.
This rapid sequence of events, from heightened tension right back to de-escalation, it just fundamentally reshaped market sentiment almost instantly.
And the most dramatic consequence of this rapid de-escalation was definitely on oil prices. Brent crude plunged a staggering 9.29% to $70.14 a barrel. That's its largest single-day percentage drop since August 2022.
And WTI crude fell even more sharply, down 12.65% to $65.51 a barrel. Just huge moves.
So why? What was the thinking behind that massive drop?
Well, the why, here's a crucial insight for you, I think. The market's worst fears, of widespread disruption to energy supplies through the vital Strait of Hormuz.
They just didn't happen.
They just failed to materialize. The missile attack, resulting in no casualties, was interpreted by investors not as an act of war, but as a carefully telegraphed military response, aimed specifically at de-escalation.
Ah, okay.
So this instantly removed that significant risk premium that had been built into oil markets. It signaled that the immediate threat of a broader conflict impacting global energy flows had significantly diminished.
Wow.
It's a powerful illustration, really, of how market prices often reflect perceived risk much more than immediate reality.
Okay, so with oil prices plummeting and geopolitical tensions easing, it's probably no surprise the U.S. dollar also saw some significant movement. It retreated 0.43% to 98.35.
Yeah, this looks like a clear case of dual influence on the dollar.
Okay.
On one hand, you had that increasingly dovish commentary coming from Fed officials. And on the other, the easing of geopolitical tensions significantly diminished the dollar's appeal as a safe haven asset.
Ah, I see.
It was kind of a 1-2 punch that sent the dollar lower. It reflected a market that suddenly felt less need for safety and maybe more anticipation of interest rate cuts.
And we certainly had some mixed signals from the Fed, didn't we?
We did.
Governor Michelle Bowman cited growing concerns over job market risks, suggesting rate cuts should be considered soon.
Mm-hmm.
And this echoed remarks from Fed Governor Christopher Waller, who had suggested a July cut just the previous Friday.
Right, but that stood in sharp contrast to Fed Chair Jerome Powell's more sort of hawkish hold the week before.
Exactly.
So these more dovish comments definitely fueled trader bets on more aggressive monetary easing. And as we discussed, the dollar's initial strength as a safe haven asset. It just quickly diminished once market participants correctly anticipated that limited de-escalatory response from Iran.
So when the big conflict didn't materialize,
That urgent need for safety, which often pushes the dollar higher, it just, well, dried up.
makes sense. Other currencies certainly saw movement too. The euro was up 0.48% to 1.1577 cents. Sterling gained 0.15% to 1.351 times.
Mm-hmm.
And the Japanese yen showed some resilience, recovering to 146.09 against the dollar. That was despite earlier weakness due to concerns about higher energy costs impacting Japan's economy.
Yeah, these movements broadly reflect those shifting tides, both monetary policy expectations and that newfound geopolitical calm.
Okay, and this calm, or maybe the market's reassessment of geopolitical risk, wasn't just impacting commodities and currencies, right? It sent ripples through the bond market, too.
That's right, a clear ripple effect.
Indeed. U.S. Treasury yields declined, again driven primarily by that easing of geopolitical tensions. The 10-year Treasury note fell 3.4 basis points to 4.349%.
Yeah, the primary driver here was definitely that market reassessment of geopolitical risk.
Yeah.
The fact that the Iranian missile attack, against that U.S. military base in Qatar resulted in no casualties.
That was the key signal.
That was the clear signal that the conflict might not escalate. This instantly eased concerns about potential disruptions, like, a closure of the Strait of Hormuz.
Which is critical for energy trade.
Absolutely critical for global energy trade. So when that risk premium comes off, bond yields, which move inversely to prices, they tend to fall as investors perhaps rotate out of perceived safe havens.
So looking ahead, all eyes are now on Fed Chair Jerome Powell's upcoming testimony. What are Fed funds futures traders pricing in now?
Well, they're anticipating a 20.7% probability of a July rate cut. That's up from 14.4% just last week.
Okay.
And for September, the probability jumps significantly. It's up to 83.4%.
Wow, that's high.
It is. Traders are now anticipating a total of about 53.9 basis points of cuts by year end. That's an increase from the 46.5 basis points expected just last week.
So if we connect this to the bigger picture, these increasingly aggressive expectations for rate cuts must reflect the market's strong belief that inflation is moderating.
I think that's exactly right. The dramatic oil price decline we just discussed plays a huge role here. It directly reduces inflationary pressures and, crucially, gives central banks more room to ease monetary policy if they choose to. It's a clear signal, really, that the market believes the Fed is nearing its pivot point.
Okay, turning to Europe. Eurozone government bond yields, they stabilized and fell slightly. German 10-year bonds were down 0.9 basis points to 2.510%.
Right.
And this also happened as retreating oil prices helped alleviate inflation concerns across the continent.
Yeah. And this raises an important question for you. How crucial is oil price stability for that whole disinflationary narrative, both in Europe and the U.S.?
It seems pretty crucial.
It's incredibly crucial. I mean, a sustained spike in energy costs would immediately disrupt that narrative, wouldn't it?
For sure.
And it would likely cause markets to scale back bets on central bank interest rate cuts. So the decline in oil effectively eased those immediate concerns, potentially paving the way for, say, ECB rate cuts down the line if this trend holds. And just to flag something quickly on the geopolitical side, that upcoming NATO summit, it's expected to focus heavily on calls to increase member defense spending significantly.
Oh, yeah.
Aiming for 5.0% of GDP from the current 2.0% target. That's a potentially big shift to watch.
Definitely something to keep an eye on. All right, let's round out our exploration today with the latest Purchasing Managers Index, or PMI, data, starting with the U.S.
Right.
The S&P Global Flash U.S. PMI Composite, it dipped to a two-month low of 52.8 in June, though it still actually beat consensus expectations.
Right.
On a more positive note for manufacturing, it showed a good turn, rising to 52.0 as factory production increased for the first time in 4 months.
But what's particularly striking here, I think, is that despite that overall sort of mixed picture, inflationary pressures intensified markedly across both manufacturing and service sectors.
Really?
Yeah, input and selling prices saw their steepest rise since July 2022. The report pointed directly to falling exports and those recently imposed tariffs as key drivers of the higher costs. So this challenging environment appears to be weighing on future expectations. Companies' optimism about output over the coming year dipped to levels well below those seen at the start of the year. So while some sectors are performing, those underlying cost pressures are definitely a concern.
Okay, but on a brighter note for the U.S., the housing market showed some surprising strength.
It did, yeah.
Existing home sales in May rose 0.8% month over month to 4.030 million. That beat expectations and reached its highest point since March.
hmm
And the median price for an existing home also climbed 1.3% year over year to $422,800.
This resilience in the housing market, especially when you consider those other inflationary signals we just talked about, it tells us that consumer activity, well, at least in the sector, remains surprisingly robust.
Interesting.
It suggests that despite higher interest rates and other economic headwinds, demand is holding up, which is, a key factor in overall economic health and maybe a testament to underlying consumer strength.
Okay, shifting to the Eurozone PMI. It signaled a pretty anemic growth, holding just above the 50.0 threshold at 50.2.
Just barely growing.
Yeah, just barely. Manufacturing continued its prolonged decline, marking its 36th consecutive month below the growth line at 49.4. Services, however, offered a modest bright spot, returning to the 50.0 mark.
This subdued performance, as they called it, clearly reflects those broader uncertainties, doesn't it? Particularly around U.S. trade policy and ongoing geopolitical tensions.
Right.
These factors continue to weigh on business confidence and investment decisions across the region, and it's also a mixed national picture within the Eurozone. Germany unexpectedly returned to growth, which was interesting, while France remained in contraction, so it highlights the varying economic health within the Eurozone itself.
And finally, the UK PMI. The S&P Global Flash UK Composite PMI reached a three-month high of 50.7. That was driven significantly by services, which hit 51.3. Manufacturing also improved to 47.7, but continued to face export headwinds.
Yeah, the struggles in UK manufacturing, you can probably attribute those primarily to U.S. tariffs, those escalating geopolitical tensions we keep mentioning, and just intense price competition.
Okay.
However, on a more positive note, we did see easing pricing pressures there. The slowest increase in average prices charged since January 2021, actually. Input price increases also moderated.
That's good news for inflation.
It is. Plus, staff recruitment declined for the ninth consecutive month, which sort of corroborates the Bank of England's views on a softening labor market. So all in all, a complex picture, slowing inflation, but, persistent challenges.
So, to summarize what we've unpacked today, we've really seen the powerful intertwining of geopolitics and rapid market reactions, haven't we?
Absolutely.
Plus the persistent dilemmas facing central banks and those mixed signals coming from global economic indicators like the PMIs and housing data. It's really been a day of rapid shifts and surprising developments.
Yeah.
Proves just how interconnected our world truly is.
Yeah, definitely. So given the rapid shifts we've seen today, from de-escalating conflicts to surprising economic data, what single factor do you think will be the most unpredictable force shaping markets and policies in the coming weeks? Is it going to be geopolitical stability or central bank actions or maybe something else entirely, something for you to mull on?
Thank you for your attention. You can subscribe to our podcast if you like it.
See you next time.